Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in, listening to the show. We are on each and every week. We got a number of stations that we're on, from Albuquerque up to Las Vegas, Nevada, in the Inland Empire, in Southern California. And that would be, of course, the Riverside and San Bernardino counties, a little bit of LA, a little bit of Orange County, a little bit out in Inyo as well. We're also up in Central California at Cape Tahoe. Last week we had a great guest from up there. Really want to appreciate everybody that comes on the show and gives us information about both properties, what's happening in the prices, what's happening in mortgage rates, programs as well. Now, we bring on the guest to the show. We'll bring one on today, Maria Schroeder. She's been on before, but we're going to talk about programs and what programs are good now today, what programs are going to be good in the future. Maybe rates will affect your decision as to whether to go QM or non-QM. All of these are options that you need to consider when you're doing a loan. The show is different every week. The show is different because we bring guests. I've got a couple of loan officers that are going to come on the show today and talk about how they get that very highly competitive borrower who needs to get into a property, either a purchase or maybe even, a refi. And how do they really get them a leg up on the competition in that purchase market? How do they get them to be able to, win the bid? One of the things that mortgage brokers, mortgage loan officers, especially experienced ones that really understand what the credit score means, what your income means, how to calculate the income properly, how to look at you as a person and understand it. Okay, I can't go cookie cutter here. I got to go non-QM, or I don't want to go non-QM here. I think we can fit this in a 30-year and in terms of getting you the property you want, you need somebody experienced. You need somebody that knows how to do that. So that's who we bring on the show today. A couple of guests, Brenda and Charles. Charles, both of them have been on the show before, and it's interesting because as the market changes and as things move along throughout this very, it's an interesting summer. A reason being is that we are at the we're at the recovery rate that we probably thought we would be at. And what's happening with rates and why the Fed is going to do what they do and where's inflation and the actual number of properties on the market. It's growing, which is kind of an oddity, especially when we see prices hike the way they've been hiking. Let's face it, over a 2-year period, prices in some areas of the country have almost gone up 20%. That's incredible. So how do we get first-time home buyers? How do we get people who either want to move up in the housing market or scale back? How do we get them into properties, and what is exactly the strategy to be able to do that? Financing is the number one reason people obviously get into buying homes. A lot of people can't afford it. And with rates dropping, they have been dropping. Right, we are back down to below 2%, just below 2%, below 3% on a 30-year fixed-rate mortgage, and that means that we've got probably another 9 million people in the housing market that can afford who couldn't afford a couple of weeks ago when it was 3.10, 3.25, and that's what it does. That's what we see. So increasing housing, which is good, increasing houses on the market, that's good, and lowering of interest rates, which allows more people into the market. So let's get to a couple of things. Kind of a news to use section. We used to do this all the time when Arby was on the show. I haven't talked to Arby in forever. And that's another thing. In our business, a lot of people stay for a long period of time. And it's a lot smaller than you might think it is, whether it's in the mortgage banking, mortgage brokering, or even in the banking sector. I'm taking a trip next month out to see the people at Rocket Mortgage, Quicken Loans. They've invited us out as Malibu Funding. Malibu Funding is the company that sponsors the show and the company that I work for. So we're going out there to talk to them about what's going on in the mortgage market, how they can possibly help. There's been a huge war in the mortgage industry between the large companies, United Wholesale and Rocket Mortgage. And they've been fighting each other in terms of market share in both. It used to be a competition whereby if you were in the lending business, if you were a wholesale lender or a wholesale broker, you could go to either bank. Well, about 2 or 3 months ago, you had to choose one or the other according to what United Wholesale was making you sign. So there has been this tremendous friction. Anyway, we're getting invited out there. We're getting wined and dined and told we're great and all the things that you do in business, try to keep your side of the street as clean as possible, really maintain brokers. I mean, the fight for mortgage brokers is huge as we have a shrinking market in the real estate and refinance section. Although, it's interesting, we're probably going to get to about 2.8 to $3.2 trillion in mortgages. Now, that's really an incredible number. But last year, it was almost $4 trillion. So we've really come down in originations here in the U.S., especially in some of the busier places. A lot of people have already refied, and they've already refied below 3%. So unless you can get them a net tangible benefit of at least a half a point or some other reason, either cash out or they got to sell their property, there's no reason to refi, and that pool keeps shrinking as the rates remain low. The remaining people that haven't done that will probably continue to try to do that. So as we have a shrinking pool of investors, a shrinking pool of people who can do loans, who can refinance their loans, that this is what we're doing. We're seeing Quicken, we're seeing United Wholesale, we're seeing a lot of the independents. And by the way, both of those companies went public this year. So there's a lot of interesting changes that help the market in some respects, and hopefully they continue to bring competition to the market, which is really about rate, it's about program, it's about providing you the best choice out there. So let's look at a couple of things before we get on with some of the bulk of what we're going to do in the show. June jobs report, 850,000 people got employment last month. The employment sector is one of those things. We have a number of things to think about when we think about employment, right? And we've talked about the number of jobs available versus the number of people out of work. We got almost 1 million people last month get a job. Most of it's in the service sector, and those are, of course, the jobs that we're lagging behind. And this is coupled with the ending of the rent moratorium and also ending of some of the COVID forbearance programs that we've had. As you know, when you go into forbearance, you get 3 months, then you got to come out unless you get an extension. So we've had a number of those people exit those programs, about 150,000, and for the first time since really April of last year, we have seen the number of people in COVID forbearance drop below 2% of total mortgages, 1.86 million people as of 7/6. I know we're a few days beyond that. But that means that we are coming to people needing to go back to work. I mean, if you're really having a moratorium, you don't have to pay your mortgage, and then the moratorium is going to end, well, guess what? You got to go back and get a job. Now, one of the other things that's obviously impacting employment is wages. If you want employed people, you need to pay them more, and that has been the strategy of a lot of different companies out there. We've seen a quit rate, which of course is the number of people who just says, I've had it, and the number of people not yet coming back to work and may never come back to work, child care, long-term health care for elderly, and one of the two members of a household that has been earning an income has to take care of those people. And so what do? We're still going to have issues with school next year. Some people are going to opt out from going to school. As you know, anybody under 12 still has no vaccine, so all of those people are susceptible to getting the new variants or whatever it is out there that you can catch from COVID and bringing it home. So all of these considerations mean that both the employment and the number of jobs available are probably not going to match for a while. And we've got, like I say, a high quit rate and a high rate of people not returning to work. And those things affect unemployment, although the number last month was pretty good. Foreclosure, forbearance. Okay, the trending bond yields is the reason for lower rates. Maybe I should save this one for the next segment. Okay, let's just get into rates themselves. 30-year fixed rate loan, 3.1%. 15 is at 2.55. The FHA is at 2.68. The jumbo is at 3.15. And, of course, the 5/1 ARM is at 2.70. The 10-year yield is at 1.419, almost 1.42. The bond yield has been really trending lower, but it has now since rebounded. We have a number of reasons for that and why rates are what they are, but they're probably going to remain very close to this for the rest of the summer. We'll see in the fall what happens if taper comes back. If taper happens, how that affects the mortgage rate, what really affects long-term rates since 1981. Let's get into that next segment. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for listening to the show. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for listening to the show, for tuning in each and every week. We try to bring you up-to-date information on mortgages, on mortgage interest rates, on why things are, how they are, what they do, and where they're going to go. Now, we're not going to stay where Karnak the Magnificent, and for anybody that's never watched Johnny Carson, you wouldn't have a clue as to what I was talking about. However, the people that we bring on the show, they have a much better idea of what's going on, and the first guest today, Maria Schroeder from Quantic Bank, is going to come on and tell us a little bit about what's going on there and some of the programs. Maria, how are you?
Good. How are you, Jeff? Thank you for having me on your show.
Thanks very much for coming on. I do appreciate it. And, you know, we have had a number of different calls on both your particular segments and other people that come on the show, because I think there's a lot of interest out there for what loan products are available and what those loan products can offer certain borrowers that might not be able to get a particular type of loan from a different lender. Give us an idea of how you're helping in that way.
Well, with Quantic Bank, our focus is to serve the underbanked, especially in light of restrictions created by Dodd-Frank and some regulations. And our focus is lending to people with low income but high worth or, wealth, self-employed borrowers, immigrants, and entrepreneurs that have, they exercise their advantages of taking write-offs, and maybe what they report to the IRS isn't really their true income. And so with Quantic programs, we can design programs that makes it easier for them to qualify with less cumbersome documentation requirements, such as, the Fannie Mae's guidelines have out there. And so we're definitely an option. So some of these borrowers get turned down at traditional banks, and they can come to you, and you can bring them to us. And our, brokers or Consumers Direct can come to Quantic Bank and take advantage of our programs. And so they could either get cash out to do home improvements or do business opportunities or buy their new dream home.
Now, one of the reasons, or the reason you can do that, is because you're a bank and you're not necessarily subject to all the Dodd-Frank rules, because you keep a lot of these loans in-house. Isn't that right?
Yes, we are a portfolio lender.
Right.
Ultimately, we do eventually securitize them. But the reason that we're allowed to do this legally is that we have our special designation. It's our CDFI, which is a Community Development Financial Institute that is given to us by the Federal Treasury. And I think 27% of the banks have that nationwide, and we've had ours for about 8 to 9 years now.
Well, that's good. Obviously, serving people who, you said, maybe not wanting to report completely to the IRS. I think it's a matter of how the business is set up, how their personal finances are set up, and that it's less complicated to go to you guys than necessarily use their tax returns or some other means to qualify. How do they qualify?
They either qualified with a profit and loss
for
the self-employed borrowers, or we have a no-ratio program. So if the borrower has enough equity in their home or the required down payment with the credit score that we require, the minimum credit scores, they can get a loan with us.
Tell me what's the best product? What's the most popular product? I guess is what I'm trying to say. Give us an idea.
My most popular program probably is our Light Doc, because we are less cumbersome than most traditional and non-traditional lenders out there, where you don't need to provide us with 24 months of bank statements, business or personal, and we will look at it with the profit and loss.
Okay, and
that is created by their own bookkeeper or themselves if they're a sole proprietor.
Okay, so it's not an accountant driven. It could be from QuickBooks or Quicken or whatever it is
Correct.
that they might use.
Yes.
I see.
Yes.
And now, minimum FICO, you talked about that. What do you guys look at? 620, 640, higher?
We actually looked for 680.
Okay, 680. And most borrowers, well, at least for us and our company, we see most borrowers, I think the average credit score is almost 700. What are you seeing in your average credit score from the loans you do?
700 to 720 is probably the sweet spot for us.
Right. And then that obviously spells for a good thing going forward in terms of them paying the loans. I don't know
Correct.
how many forbearance loans that you all have been involved with, or do you know that? I'm guessing there are some.
I know that when we did our statistics, especially coming out of the pandemic and going through the pandemic, our executives had told us that none of our books of people, I think, that have they were very self-guarded because, we require our types of borrowers that are coming to us are very solid. So, so I don't think any of our
That's good.
People did forbearances. But if there has been people who, took advantage of forbearances, we just want to make sure that they're completely out of it and on track before they can come back, come to us to apply for a loan.
Okay, and let's talk rates a little bit. What is the spread on the rate that you'll get for somebody who's, let's say, got a 720 FICO score and is using one of your either bank statement programs or your P&L statement?
We're doing it at a 30-year fix,
Mm-hmm.
and at like 5.5
Mm-hmm.
to about 6%. We do offer interest only. You have to keep in mind these loan documents and these programs are very minimum and requirements and loan income documents, and so
Right.
there was these before Quantic came around and offered this to the masses. These people were going to private lenders.
Right, hard money, private lenders, right, and the interest rates are, 10%, sure.
9 to 12%.
Right.
Rates, yes.
That's right. No, I love this program because they're reasonable rates and they're able to use and be used. What kind of loan to value are you looking for in all this?
75 to 80% is
That's good.
typically what I'm doing. But our average company-wide with our portfolio is probably about 65.
Okay, and rate is affected by the amount of money in the deal, I assume, yes?
Correct.
Okay, and that's pretty good. What are you seeing in terms of how the lender, how Quantic Bank is going to adapt to the changing ways the DTI is being looked at? Since you're a bank, I guess that doesn't really affect you as much because you're not selling to Fannie and Freddie.
Correct.
So
Well, it's actually opening the floodgates for us.
right. No, I'm sure.
Because
Right.
Yeah.
Now, from what I understand, when it becomes mandatory in about a year, we're going to be looking at a 3-year, where you have to keep loans on the books and then you can sell them to Fannie and Freddie. Have you heard about this?
No, because you know what? We do our special portfolio product.
I
so
see.
We don't even offer the
Any of those?
traditional Fannie Mae. Yeah.
I see.
I don't. It's been a hot minute since I've done it. So
No, well, I think the reason I bring it up is because a lot of the industry is going to change. They're changing the way the DTI is affecting loans sold to Fannie and Freddie. They're actually doing away with it. They're coming up with a percentage based on how the loans are priced. And if you are below that particular price, those loans are available. But if you go into a higher price or into a rebuttable, those loans after 3 years can be also sold to Fannie and Freddie. So there's this whole new way by which loans will be looked at, and for obviously a lender like you who is already offering products like that on a portfolio basis, that's going to be a good thing. I mean, on the one hand, they're closing down some of the loans that are going to be offered, yet at the other hand, they're saying, okay, if you can find a bank that portfolios these, you can then sell them 3 years later, so it's almost, it almost washes out if you can find that bank. But you hold all your old papers, so it's not going to matter to you guys.
Yes, we hold our paper and then we securitize them in mortgage-backed securities on Wall Street. We're So I think that in the future, with the new changes, I can see Quantic probably coming up with new programs to kind of help out,
Right.
the people who are going to be infected that are going to need loans, right?
Right. No, I agree with you.
Yeah.
And I don't think they've really, well, they've delayed it a year, right? It was supposed to start this July, but it's voluntary right now, becomes permanently that you have to do it, I think, in a year. Anyway, we are up against the clock. Maria, thanks very much for coming on to the show, talking to us about the great programs over at Quantic. Appreciate it.
Thank you for having me, always. So appreciated.
Thank you. Thanks, Maria. That's Maria Schroeder from Quantic Bank. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show each and every week. If you want to talk to me, if you want to hear me, you can go to YouTube. I've got a bunch of different ways that you can not only like the show, but you can contact me. And that's Jeff Barton, the Mortgage Voice. And I've got a channel, probably have 200-300 different shows on there. Each week we put the segments of the show up. We also have a website. It's Jeff Barton, the Mortgage Voice. That's all new. If you go to podclips.io, that's also new. A great place where we house not only the show, but there's a whole bunch of different podcasts there. And it's like a channel where they have probably 30 different ways by which you can listen to different kinds of podcasts: health, sports, lifestyle, and finance, and that's where you'll find us. We're also on a number of different podcasts. Darryl, where are those podcasts?
They are all over the place. They are at Apple Podcasts, Google Music Play, Spotify, Spreaker, Stitcher, iHeartMedia, Radio.com, YouTube, and as you had mentioned, podclips.io.
Excellent. Also, we're on 5 radio stations in 3 different states, from Albuquerque to Las Vegas up to the Inland Empire in Southern California, San Bernardino and Riverside, and what's the other place we're in? Tahoe, right?
Tahoe, yeah.
K-Tahoe, of course. How could I forget that one? But thank you again for listening, bringing you good people who know more stuff than I do. Another person that's been on the show several times that can talk to us about what's going on in the loan business is Brenda Scott from Malibu Funding. Brenda, how are you?
I am great, Jeff. How you doing?
I'm okay. Thank you very much. I was sick last week, got a little bit of a cold, summer cold, and of course, if you cough around anybody right now, they just run for the hills. So I've been triple masked. I had my, hockey mask on, so they think I'm Jason or whatever that person is. Anyway, so
you can't cough because it's COVID. You cough.
Forget it. You can't have a cold nowadays. You might as well stay home. People just gonna shed you.
You're automatically gonna die if you get a cold.
Oh my! It's been terrible, but I've been back really at the office for a couple of weeks. It got me down for really a solid week.
Yeah, I heard you. You didn't sound very well at all.
Yeah, that's true. Well, I don't know how I sound today, but at least I'm up, I'm prone, and
well, you sound great today.
Oh, excellent. Well, thank you.
Let's do it. Let everybody know how great Malibu Funding is.
Excellent. Perfect. I love that. Tell us about what kind of loans are popular right now and how you're helping your clients get into that purchase property.
Well, I tell you, Jeff, I have a good lender that we're doing purchases on, and the required FICO score is 520.
520. Really?
520, and you can get, it's FHA.
Yep.
But we also have that SHAFA loan. A lot of people are beginning to use it a lot more than we have, where it's allowing borrowers to get in a home with 100% financing.
And this is the CalHAFA you're talking about?
Yes, this is a CalHAFA where they will finance the down payment and they will finance the closing costs.
Okay, that's excellent. Now, when you say you're getting these people, getting people excited about it, 520 FICO score, what are the other requirements and what's the rate?
Rates might be just a tad bit high, but you still can get 3.5, 3.7. That's
what's wrong with that?
Doggone good rate.
Oh, heck yeah, it is. I mean, you pencil that out. That'll work.
Very good rate, yeah.
Okay, and are these on purchases or cash out refis? What are they on?
These on purchases. I'm doing these on purchases.
Wow.
But we can also do refinance cash out too. But, obviously FHA has a max cash out that you can get, but you can still get the cash out.
No, that's excellent. Okay, and so on purchases, let's talk purchases. We see the inventory up a little bit, but I'm not quite sure that, that is the, it's just not enough in order to solve what's happening, which is you have multiple people looking at the same house, looking to buy the same house, multiple offers. How are you helping your borrowers, get beyond that? What kind of I guess, pre-approval are you giving them?
The borrowers are going further out. They're going to San Bernardino, Rialto, Fontana. There's a couple of they're going more inland now, and when you go out that far, you do have the option to put in a good, decent offer, and not have to put 20 offers in at one time. So there are homes available in those areas.
Oh, yeah, there's a lot of homes. If you go up to 15 Quarter, or whether it's Hemet or Hesperia or some of the other places out in that area.
Hemet and Santacito.
Yeah.
They're all doing extremely well right now. The values out there is not as high as the values more toward, the Los Angeles, Orange County areas, but you can still buy a house instead of renting. If you're paying $2,200 to rent, you need to buy a house.
That's interesting you say that, because a lot of people who are renting are paying way more than they would pay if they had a mortgage for a house. But the problem has always been the down payment. But you're saying that with this company, with the Cal HAFA program, now this is, of course, for Southern California or California in general. It's not for, let's say, in New Mexico or Nevada, where we've got the show also. But there are programs all over like that. But that's how we get people into a property who might not necessarily be able to afford a down payment, is to find programs like that. And certainly with FHA at 3.5% down normally, it's still the way to go.
Especially and even on a conventional, if you have a non-conventional, you can buy out that MI, and that MI is really, that's an additional $200-300 a month. You can buy that whole premium out and not even have to pay that MI.
Explain that.
It's a lot of creative. Well, we have one right now in the system, and hopefully we're going to be docking it pretty soon. It's a 90%, and the rate is good. The rate, I think, is 2.25.
Right.
And he is buying out his MI. So let's say the MI, I'm just giving you a number, is $5,800. So along with the lender credit, because the lender will give us the credit because of our relationship with that lender, they will give us the credit. So maybe the client may have to come out of his pocket, maybe $1,200, but that whole MI premium is paid for up front. So you only have your PI when you're making your mortgage payment. You don't have MI insurance anymore. So we can't do anything with MI insurance on FHA loan. This is strictly a conventional loan.
I see. Okay. So, and MI, of course, is anything below 20%, 80%, right? I mean, if it's...
Right. So even if you want to refinance, and this gentleman is refinancing, and he was initially coming out with about $60,000. So we redid everything, got a updated appraisal on it, and what was $60,000 is now $14,000, and he's buying out that MI insurance at $5,800. It's an excellent deal for him. Excellent.
That's an
excellent. Save him $320 a month.
Oh yeah, that's a big deal. That's a big deal on any loan, let alone
because the loan amount it's like $560. So the higher your loan amount is, the higher your MI is going to be.
Tell me where we're heading in the marketplace.
Oh Lord, you really want me to tell you that? I think we're going to be. I think it's going to pop again, Jeff.
Meaning, you mean the rates go up, or meaning what?
I think the industry, I think the real estate, I think this whole market is going to be reshifted probably in about maybe 2 years. I mean, we still got 2 years, and interest rates are still extremely good.
I agree with that.
FHA rates are extremely good right now, so everything is good now. So get in now.
Well, that I agree with you.
A good rate.
I agree with you. I just, I look at where we are in terms of both the housing product, of the availability, the way the interest rates have really been propped up by the Fed buying mortgage-backed securities and bonds. What happens if inflation? I just look at a lot of things affecting rates. I can't see the rates staying like this forever, especially if they go into a taper. But
I agree with you.
Yeah.
I agree with you. And the one thing I do want to let listeners know: before we couldn't submit a loan for an approval if you didn't have a property, but now lenders are allowing us to go in and submit that loan and do a to be determined on buying that property. So you get a full-on approval. So when I tell you you are approved for $500,000 purchase price, we got it in writing because we got an approval already.
Right, and that's excellent. Hey, Brenda, we're up against the clock. You want to shout out a phone number for people to get in touch with you?
Hey, yes, please. Brenda Scott, please call me at 562-500-2400, and I will be happy to answer any questions that you may have.
Thank
you, Jeff.
Thank you, Brenda. Thanks very much for coming on the show. That's Brenda Scott from Malibu Funding. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. If you want to see the show, go to YouTube. Jeff Barton, the Mortgage Voice. That's our mortgage channel there. You can also go to a number of the radio stations, KCAA, KMET in Southern California. They carry a live feed. K-Tahoe is one of the other stations. We have, what's the one, 1400 AM in Vegas? What's that?
That would be K-Ship.
K-Ship, KSHP, of course, and we're on K-Mine Country down in Albuquerque. I want to say hi to all those great folks down there. We're on 5 stations, 3 different states. Real happy to bring shows to you about mortgages. I know, get the pillow, roll out the blanket, start to get comfy to go to sleep. No, it's not that kind of show. We're going to show you how you can get a house. We're going to show you how you can get a good mortgage. There are different kinds of programs. If you've been shut out or turned down by somebody else, we have experts who come on and talk to you about it. I'm not going to sell me. I'm going to let them talk to you about what's really important is either getting you the house you deserve or getting some money out in order to pay those bills off or pay some medical expenses. There's all kinds of reasons that you need a loan, and with the rates the way they are, now's the time to do it. With us to help really sort through the bunch of stuff that I've been talking about is Charles Giscom from Malibu Funding. He joins us once again. Chuck, how are you?
I'm outstanding, Jeff. How's everybody doing?
Well, just great. Thank you very much. And like many of the NBA playoffs, there's a lot of no-names out there, but they still can offer you terrific rates. Tell us about some of the programs that you see.
Oh, man, Jeff, there's so many things going on right now. The competition is stiff.
Yep.
The mortgage programs become plentiful. There's a plethora of different programs that people are not aware of that we love to tell them about, to let them have another option, an alternative to get into the market. So I'll tell you, we have the traditional loans, of course. Malibu Funding does all traditional loans, Fannie Freddie, USDA VA, Ginnie Mae, FHA, for you people that don't understand the other things that I just said. They're just governmental loans. But there's also non-QM loans, non-traditional mortgages that allow individuals to get in that are less strict, less stringent in regards to the paperwork is concerned. These loans are comparable in interest rates to what you normally are seeing in a traditional market.
Right.
It will help individuals who are self-employed, who don't have the tax returns done yet, or who just doesn't want to show all the information. These loans are super helpful for people to take advantage of this market while the interest rates are still where they are and get in without feeling like they will be, that they don't fit the bill or they can't fit into the box of traditional mortgage lending.
I talked to our account executive over at Rocket Mortgage today, John Gruca, and he said He said, that Charles, he's in North Carolina, he's in Las Vegas, Nevada, he's in Illinois, he's all over the place for you. And I said, yes, he is. He's a very experienced guy and doing loans. So the question being, loans around the country, the different needs, different markets, depending on whether it's purchase or refi, what are you seeing as differences, if there are any?
You know what, Jeff? It's so funny because at some point you'll have a market that is doing more traditional loans, or you'll have a market that needs more non-QM loans, or people doing different loans. It's kind of like a nice little jambalaya now, Jeff. I'll be honest with you. Everybody needs everything because now more and more people are looking at doing investment properties, more and more people doing commercial loans as well as traditional loans. So I find out everywhere that we're doing loans at Malibu Funding, everybody pretty much needs the same thing. The investors are looking for short-term loans that can do after repair value, meaning they can provide renovations, get them in for a lower clip, as well as traditional loans. Hey, listen, I'm going to buy an investment property. I'm also going to refinance my home since the interest rates are low now. So I need you to do a traditional loan. I need you to do an investment loan. So all over, all the different places, whether it's North Carolina, Florida, Las Vegas, Illinois, even investment properties in New York, different things that we're doing.
Right.
What happens is that everybody pretty much is across the board because the market is so hot. Everybody's looking at every arena of the real estate market and the mortgage market to find out where that money is and utilize it best they can.
Now, we have a number of weather-related events in this country, whether it's a hurricane or an earthquake or a fire, and certainly the tragedies down in Florida with the apartment building collapsing. Do you see certain markets, depending on what happens, especially down there in Florida right now, what happens to approvals in situations whereby you either have a weather event or something like the collapsed building? How do we value those kind of properties? Not those particular, but the ones around it, the ones that might be affected. How is it going to affect approvals that have already been done or funding that are being waited to be done? Is there a delay in that sort of stuff? What are you seeing?
You know what? You would normally think there would be a delay. And we went through this one time before, Jeff, when we were dealing with the fires, and we could not get some properties done because the fires were so hazardous and they were spreading around surrounding areas that didn't normally think that they would be hit. It's the same thing down here. They're obviously going to take another look. The inspection process obviously is going to be strict and very tight to make sure that these type of properties, whether you're getting into a warrantable condo or non-warrantable, for individuals that don't know what that means buildings and condominiums that are meeting certain requirements that Freddie and Fannie give out as well as FHA give out. If the property is warrantable, it means that it can be backed or insured by that particular branch. Or if it's not non-warrantable, you go into a situation where you can still get lending on it, but it doesn't meet those Freddie Fannie guidelines. And we go to inspections and making sure that everything is good. You always should get an inspection, because an inspection now costing you a little bit of money can save you a ton of money later. So you always have to take those things into consideration, and especially in that market now, everybody's very wary and mindful of what is happening. So they'll be very strict, and it might be some delay, but at the end of the day, they'll still be lending. And it's just a word for wise for everybody. You always should take the time out and make sure you get a complete inspection on your property. Now, the way the market is right now, a lot of people buy stuff sight unseen. But because of the current tragedies and different things, I think people will take a step back, wait a little bit, take a good look at it, get that inspection done, and find out what they're getting themselves into. Because it's always something when you inherit someone else's problem into your new situation. But that's what inspections are for. Make sure that we're solid in our decision. Get your financing tight with Malibu Funding, and then go ahead and jump into the market.
What do you see as the future in the next 5 to 6 months, both with the rates and the availability of mortgages? Do you see more mortgages, different types of products coming on the market? Do you see rates rising a little bit because of inflation? What do you see?
I always like to say I'm definitely not Stradamus, because I don't know exactly what the future is going to be.
Nobody does.
But I will say that we've they've been saying that the interest rates are going to increase, and that's just based upon cycle, Jeff.
Sure it is. Yep.
Cycle happens. Those who are first or last, those who are last are first in regards to the interest rates and value. But we've been saying that it's going to go down, and it's still steady and very competitive right now. In the next 6 months, I would say, yes, it's a possibility of a downturn. But while you get to that 6 months, you should jump in right now because interest rates are really good, still good, surprisingly, Jeff.
It's great. It's amazing.
The market is still hot. I would just say, I say to everybody, going into the last turn, because we're getting towards the end of the year now, I would just be strategic. If you have a great offer or you're going to get a property, obviously it's a seller's market still. But even in the seller situation, get what you can. Don't be greedy with it, and then just keep moving on and keep buying. I have a ton of people who are saying this market and what people are saying about it doesn't affect them. They're buying. I had one client today, Jeff, asked me for 8 pre-approvals to go out there and get houses done and get some multi-families done. So people are very confident and comfortable.
Oh, excellent. Well, anybody that's got that kind of money and foresight to see, even if prices are a little high or even a lot high, the interest rates are so low that the monthly payment is what you're looking at. And if that is something that you want to, you know what I mean? Anyway, Chuck, I'm here at the end of our segment. Could you shout out to people how they can get in touch with you? Great loan officer in a number of different places.
Absolutely, Jeff. I appreciate that. You can get in touch with me at that 702-328-5191. Again, 702-328-5191. And you can email me at charles@malibufunding.biz. That's charles@malibufunding.boy Isaac Zenith.
Excellent. Thank you very much once again for coming on the show, illuminating, elucidating, helping people really figure out the mortgages. Thanks, Chuck.
Jeff, thanks for having me over.
Thank you very much. That's Charles Giscom from Malibu Funding. I'm Jeff Barton, your voice in the mortgage industry, and we will be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in, listening to the show. We're on each and every week. We're on a number of different podcasts as well. If you want to hear us on those podcasts, Daryl, you got the list of those?
I sure do, Jeff. It's Apple Podcasts, Google Music Play, Spotify, Spreaker, Stitcher, iHeartMedia, Radio.com, YouTube, and Podclips.io.
Thank you very much. Podclips.io. Go there. It's a new place where you can see a whole bunch of different kinds of podcasts. We are in the financial section, and that's Jeff Barton, the mortgage voice. But there's lifestyle, there's health, there's sports, there's all kinds of things there. And I think it's a great place to center your podcast listening. Also, we're on YouTube. Jeff Barton, the mortgage voice. You can see this as well as, really hundreds of other shows. We've got a new website as well, themortgagevoice.com. Is it mortgagevoice.com?
It is. Yes, it is, Jeff.
Okay, excellent. So if you want to see us, go to YouTube. If you want to see the new website, that's there. Obviously, Podclips.io and all these other places where you can listen and hear the show. So let's get back to it. We were talking in an earlier segment in the show about yields, bond yields, and why rates are what they are. We always follow the 10-year, and I've said as a rule, if you're looking to see where rates are headed, look to the 10-year yield. Why? Because the 10-year yield goes up, rates go up. They go down, rates go down. And you can pretty much see the trend line if you go to any of these stock reporting services, and even if you have some of your own resources, just look at the 10-year yield and what it has been over the last year, the last 2 years. You can see the trending line, and that's pretty much where rates are going to go. However, we have had some different ways by which we can value or look at rates and how they are affected. One of the ways and one of the things that we talk about is, of course, how long have the trend lines been trending downward? Now, we look in terms of weeks, days, months maybe. But since 1981, is it 81? Let me look. Yes, it is 1981. We have seen the trend line. Now, nobody remembers, but in 1981, It was the second or first year of a Reagan administration after Carter was president. During Carter's presidency, we saw inflation hit 18%, and we see CDs at 21%. Okay, so that's then. Today, of course, since that time, 1981, we've seen the trending bond yields downward for, what is that, 81, 91, 40 years? So we have seen the long-term trend of bond yields downward since 1981, and that really reflects how interest rates, if you look at interest rates and how they are matched up with the long-term bond yields or the 10-year bond yields, you will see that this is where it has been headed, and now we are at where we are now, where we've got interest rates, mortgage interest rates, below 3%, 3% below 3%, and we've been here for a year. And that's amazing. But even before that, even before COVID, even before not tapering, but even before the Fed stepped in and bought bonds and bought mortgage-backed securities, we still saw interest rates incredibly low. So what other things affect, or what other thing really matters? Well, one of the problems with what we have today is we have two things going on. To effectively help the economy, the Fed has agreed and really what they call it, what do they call it? Not accommodative, that's what it is. Accommodative policies, which means that they're going to buy mortgage-backed securities at $40 billion a month, and they're going to buy treasuries at $80 billion a month. And they've been doing this since the start of COVID, right? And I talk about it every week. So everybody who listens to the show knows that. So one of the problems with that, of course, is that we have a recovering economy during COVID, where we have, let's say, 59% of the adult population in the United States vaccinated. It's pretty good, right? So most people are out, they're spending money, and they're spending that $1.5 trillion that they've got saved up, and they've got all this borrowing power, and they've got money that has been really freely handed out by the Fed to businesses in order to continue to grow the economy. Well, the problem there is we have inflation. So we've got accommodative stance by the Fed fueling inflation. And inflation in and of itself will make rates go up. Now, why do I say that? Because if you're going to buy a bond today and it's worth 5% less in a year than it is today, you're not going to be too happy. So the only way to reverse that trend is to up the interest rate so there's less demand. Less demand means that that particular bond will have to raise in price and raise in yield bond yields. And both of those things are anti-inflationary measures which can help the economy if inflation is in fact raising rates. So there's a conundrum here, right? You have to raise rates in order to not stop inflation. But in order to stimulate the economy, low rates have really been what the Fed has been talking about. And both of these things are really high-class math problems. And we as consumers, I looked at a few things, right? Inflation is a big deal to people on the street. Everybody here in California knows $5 a gallon of gas is no picnic, right? Nobody wants to pay that. They want to pay what they pay in Texas, which is about $1.80 a gallon. But they're not going to, because California has its own set of taxes and its own way to fund what they do here. And so as a result of inflation, gas being one of the things, there were three types of inflation. The president yesterday called inflation transitional, meaning that once we get past this initial phase of, whatever place the economy is in, and supply chains get back to what they're supposed to get back, and we get to more even flow back to what it has been, back to where supply meets demand, we will see prices come back down. He points, of course, to lumber. Now, I don't know if anybody follows these things. We talked about it a little bit because building, of course, is at the heart of what we do. When we talk about mortgages, you don't have a house, you can't get a mortgage. Lumber prices at their peak, which wasn't really all that long ago, and it's because they shut the sawmills down. We saw lumber prices, and this may be something you don't understand in terms of lumber foot, but if we compare lumber foot per thousand 8 months ago, which was $1,733 per thousand board feet, to today's price, which is $712, That's basically $1,000 less in 8 months, almost 60% less. This is what Biden is talking about when he's talking about transitional. Prices will come down, inflation will come down. But some of the things which have really, that I looked at, I wanted to pass on to you as to things that are inflationary and how much they have been inflationary. Used cars. Anybody bought a used car lately? You would think, because of the fact that they're used cars, and there seems to be a huge number of them all the time, anytime I look. Well, apparently not. Used cars themselves have gone up 45% during the last year. 45%. The 2-year jump, this is before COVID, 41%. Now, why is that? Well, because if you want a car, or if you want a different car, it's a lot cheaper to get a used car than it is to get a new car. And a lot of people have gone that route simply for that reason. What's another thing? New cars. Okay, we went to used cars. New cars. New cars are up 5.3% on a 12-month basis. Okay, one thing about cars, new cars in general, you may have heard that there's a chip shortage worldwide. How your car runs. Anybody, Daryl, do you remember? Do you have a car back from the 60s or 70s that you used to drive around?
I used to have a 63 Le Mans.
Okay.
Le Mans,
You open the hood, there is no electronics in the things. It's all, no, it's just wires and fuses. That's it.
Things that blow up gas.
Oh my gosh. Well, today, you open up a hood of your car and most of it is science. It's all technology and it's all driven with semiconductors. And so it's really difficult to get a semiconductor, to get something to be able to, a chip to put in any new car. That's why the prices have gone up so much. Anyway, we're up against the clock. I'm going to read out a few more things that you already know this, but I'm going to tell you anywhere. Airfares up 24%. Hotel rooms up 15%. Rental cars up 76%. Clothes are up 5%. Restaurants are up 4%. Now, all of these things are up year over year. But if you look at a lot of them trending over the last 3 years, they're really still down. But compared to the sticker shock that we had when prices were down and then they came back up, it's a real shocker. Anyway, I'm Jeff Barton. Those are some of the things I'm thinking about that'll affect you, your money, and how you're going to be able to calculate whether you can get that mortgage. Thank you very much for listening to the show. I'm Jeff Barton from The Mortgage Voice, and we'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.